All right, here we go, guys. We've got a special guest in the house, Marlon Alto from Eagle Strategies. Thank you, my brother, for jumping in. I really, really appreciate it. I know this is the busy time of the year.
No, it's my pleasure. I think this is the perfect timing for people to get a little understanding of their opportunities to put some money aside from themselves. So
I
I'm
agree.
glad.
I agree. I think the timing is can be better. Just guys, super briefly about my friend Marlon Alto. So Marlon is a financial advisor with Eagle Strategies LLC. He's registered investment advisor. He focuses on providing a comprehensive fee-based financial planning and advisory services, with the emphasis on estate planning, retirement planning, and asset management. Super, super important. Although Marlon works with folks from all walks of life, his clients are primarily highly successful professionals, families, and established owners of closely held businesses. Marlon's office utilizes a team approach and put a great value on direct, honest communication. They seek to work closely with clients and all their trusted advisors as attorneys and accountants to identify each client's unique needs, because everybody's got a unique scenario, right? Now, through a
For sure.
goal-based financial planning, Marlon and his team ensures that their clients have set up proper building blocks to build a secure financial future and are taking the right steps to grow and protect their assets throughout their lifetimes and beyond. Here you will find a team that is deeply committed to their clients and consider them part of the extended family. Now, a little bit about Marlon. He's very active in his community. He's a member of New York State Society of CPAs and sits on estate planning, family office, and business continuation planning committees. Marlon holds a Bachelor of Arts in Political Science from Baruch College and strives to maintain close ties to his alma mater, where he sits in the Weissman School of the Art and Science Dean's Advisory Council and acts as the co-chair of LGBTQ Baruch Alumni and Allies Group. Marlon is certified financial planner and chartered financial consultant, candidate through the American College of Financial Services. Woo!
That's a mouthful. Well, thank you for that introduction. It was fantastic.
No, thank you, brother. Thank you, brother.
Never
Thank
get
you
to
again
hear.
for jumping in and really educating us about this topic, because it's kind of a taboo, right? People always think, oh, I might not have enough money to invest. It's too expensive. I've got plenty of time, right? And then all of a
Absolutely.
sudden, the time is gone. So without any further ado, Marlon, go for it, my brother.
All right, folks, I think this is a perfect time for you to do a little thinking about what you can put aside for yourself. You can still maximize your 2020 contributions up to your tax deadline. And if you're a business owner, if you're doing SEP and simple IRA contributions, that can even, if you're filing an extension, could go up until September. So there's plenty of time for you to do a little thinking about this. So I'm going to give you some basic information. If you have any questions, feel free to reach out to me after, and we can discuss it in more detail. So now, what type of IRA is right for you? The more than ever, IRAs can offer you opportunities for, tax beneficial savings that can definitely add a lot of flexibility to your financial planning. So these presentations look at different types of IRAs, their advantages and the limitations, and some regulatory improvements that has happened with them in the last few years. There you go. These are the most traditional types of IRAs out there. And so the Tax Relief Act of 97 is the law that created the Roth IRA. It also enhanced the traditional IRA and created the opportunity that you might want to consider in the future, and we'll talk about this more, of converting your traditional IRA into a Roth IRA if that makes sense for you. All IRAs, however, offer tax advantages and allow you to make investments that are smarter for you and for your money. So for the years 2020 and 2021, the maximum contribution you can make is $6,000. These will be sometimes from time to time increased, but this year they're staying flat. If you are
let me ask you a quick question. The $6,000, that's per individual, correct?
That's per individual for all accounts. So if you had 3 IRAs, you can only put in 6,000 for total, meaning like you can put 2,000 here, 2,000 there, 2,000 there, but it cannot exceed 2,000. I mean 6,000 altogether.
Understood. So, and that's post-tax, right? So the money will be then tax-free, correct?
So there are different types of IRAs, and we're going to get into that.
Got it.
The traditional IRA, it will be pre-tax, so you will get a tax deduction for it. A Roth IRA will be post-tax money, so you will pay taxes on it first, and then you're going to put it into it. But we'll get into more detail in a little bit. Yeah. So if you are 50 or over, you can contribute an additional $1,000 for us catch-up contributions. We want to make sure that
$1,000 only.
For the catch-up contribution, so 6,000 for your traditional, contribution.
I'm just joking. I'm just joking. But how are you going to catch up with 1,000?
I know. Well, we will get to the, to business owners of self-employed, SEP and simple IRAs, and those offer you much larger contribution limits. So perfect. Those could, give you even up to $58,000 you can put away for yourself, and get a $58,000 deduction if you have employees, and bigger than that. So there are options for us entrepreneurs out there.
Perfect.
So this year, if you made less than $66,000, you can also qualify for a credit, a one-time credit. It's called the Savers Credit. You should talk to your CPA whether that will be, and it's a credit. It's not a deduction. So it'll be a dollar for dollar reduction on your tax bill. So let's say your tax bill $1,000. You are eligible for $100 credit, then your bill would be $900. Unlike a deduction, it just lowers your bill according to your tax bracket.
Got it.
So let's talk about the traditional IRA. This is the granddaddy of them all. It is the one that started the whole process, right? Money placed in traditional IRAs may receive a tax deduction, so you can keep more of your money to yourself. It will also grow tax deferred. Tax deferred means that every time you receive a dividend or you receive a capital gain distribution, in normal investments, you have to pay taxes on that. In an IRA, you do not. The money stays in, more of your money stay in the account, so you can grow it faster and larger quantities, but you will have to pay taxes in the end when you take it out. So due to the Secure Act passed in 2019, many IRA provisions have been modified. So before, when you reach 70.5, you had to start taking your required minimum distributions. This is money that you don't have a choice. You have to take it out because the government wants their tax dollars. They pushed that back a little bit. So now you can wait until 72, because it sounds crazy, but a lot of people do not need their distributions. They have enough income coming in from other sources, but they're forced to get paid taxes on it, and often enough have to reinvest. So this is a great thing that has happened. If you're considering whether you're eligible to the traditional IRA, you are most definitely eligible. Anybody who makes money or has an spouse who makes money is eligible to contribute to the traditional IRA. Even now, they've changed this since 2019. You can continue to make contributions after 7.5. You should particularly be interested in an IRA if you can make deductible contributions, because that is a huge boost to your savings. So let's say you make a $6,000 contribution to the IRA. That is an above line deduction of your income that will come off of your income, so you can keep more of your money, pay less to Uncle Sam, and live a better life, right? So this should be, but nonetheless, you are also eligible to roll over money if you have an old 401k or old 403b and you want to roll into an IRA. You also can do that. The amount that you can contribute, though, not the amount to contribute, the amount of the deduction may vary depending on your income. If you file jointly with your spouse, if you make less than $196,000 combined, you can take a full deduction. If you make more than that, your deduction is going to get a little smaller, and up until a point where you can't take it out. You can't get a deduction anymore whatsoever. If you're covered by a retirement plan, but you can still get that deduction as long as you made less than 65,000 for a single person and 104,000 for a married filing jointly person, right? So this means that if you make more than $65,000, you might be able to put the money in, but you might not get a full deduction. You still get the benefit of the tax deferral on the money, though. So, and it does not affect how much you can put in. So the withdrawals with IRAs, because this is a retirement account, they want to incentivize you to keep the money in there, right? So if you take the money out before you're 59 and a half, there may be penalties because they want to, discourage you from taking that money all the time. IRA distributions will be taxed fully as ordinary income, which is the highest tax rates that we can possibly have. If you take it out before 59 and a half, there's an additional penalty tax of 10% on the growth. Since the account is designed for retirement, though, in retirement, you might have a lower tax bracket. So you might be paying less taxes on the total amount, which you can keep more of your money. As we said, there are required minimum distributions now starting at 72. And there are some exceptions to the rule that you cannot access the money before 59 and a half. So if you are buying your first time home, you can access $10,000 of it. If you're having a child or adopting a child, now you can take out up to $5,000. If you become disabled, you can take money. So there are different life circumstances that will allow you to access it. Some, if not all, the money.
I see over here, if somebody takes the money to buy the first home, then also there will be no fee.
Correct, but that's only $10,000 and it's only once. And you do have the opportunity, for example, if you want to put it back into the IRA later, they'll just treat it as a rollover. So if you want, if you want to think of this just as a temporary loan, you can as well, right? So you can take money for some qualified medical expenses, some qualified educational expenses. Again, $10,000 for the first time home purchase and once, and $5,000 for any time you are having a child or adopting a child. So now we're going to talk about the Roth IRA. While the Roth IRA does not give you an immediate deduction, what it does give you, though, is the ability to take out the money when you're in retirement without having to pay any taxes, zero taxes on the money whatsoever. So for many,
it doesn't matter how much it grows, right?
Doesn't matter how much it grows. Let's say you put in, over your lifetime, you put in 100,000, but it has grown to $1 million. You will pay $0 on all of them, the entire, right? Because you have already paid taxes on that 100,000 because you don't get the deduction, right? So it's called a post-tax contribution. So whatever contribution it is in there is you won't pay taxes on, and the growth as well you will not pay taxes on. So for a lot of people, this can be a very, very good option.
Especially for youngsters, right? I mean, you can really build it nicely if you've got that runway, and you can deliberately, every year put $5,000-$6,000. I mean, that can be a game changer.
That can be huge, right? And it also offers you a lot more flexibility because it is post-tax money. Whatever contribution you've put in, you can always take it out. So let's say over your lifetime, you put in 200,000. The account has gone to 500. You're in a bind and you need some money, you can always take that 200,000 that you originally put in, tax-free and penalty-free. So it's a lot more flexible in a certain sense than the traditional IRA. It does not have the requirement for required minimum distributions. So you can leave the money in the account as long as you wish if you don't need it, right? So it offers a lot more flexibility than the traditional IRA does. And the fact that you don't have to pay taxes in the end usually means that you get more net for net dollars when you retire. And I'll show you a table that, shows that. However, the Roth IRA has income limitations into how much you can contribute into a Roth IRA, unlike the traditional that does not have income limitations into contribution amounts. You can only contribute up to $6,000 if you make less than 124 as an individual or less than 196 as a married filing jointly couple. After that, there's
let me ask you a quick question. I just have a question. So now, can anybody contribute through the Roth, even though if you, let's say, self-employed and you don't give yourself W-2, or do you have to be a W-2 employee?
No, anybody can contribute as long as you qualify in the income range. Anybody can contribute. Yeah. So there is no limitation. It's not limited if you're covered by an employment plan. It doesn't matter. All it matters is the amount of income that you might have.
And the contribution has to be made before filing the taxes or after filing the taxes, obviously, right? Right after, or?
Well, contributions can be made at any time, because normally what happens is either your employer will have already taken deductions from or if you don't have an employer, you will pay future taxes on the dollar that you put in, right? So when you file your taxes, the government's going to say you have to pay taxes on that money. But for most people, they have their taxes withheld by their employer. If you're a small business owner, when you file your taxes, then you're going to get a bill. So, it doesn't matter when you contribute. It's the same rules and regulations in terms of you can contribute up to the tax filing deadline for the previous year. Right.
Got it. So I think it was extended. I think this year was extended from April 16 through, I think, May 17, right?
Correct. Yes. So normally it is April 15th is when you can make your 2020 contributions up until. So let's say you didn't have the opportunity to maximize your 2020 contributions last year. You have until the tax deadline to do so, which, it's a boost. It's a great boost to a lot of people. So why would you choose a Roth if it doesn't give you a deduction? Well, we already discussed a lot of the benefits, right? But there are a lot of other benefits as well. So for example, let's say you pass away and you leave a large IRA to a beneficiary who's not your spouse. That beneficiary has to take all the money out in 10 years because the government wants its tax money. And because you have to pay taxes of the entire amount, that can be very large amounts for people who don't have the means to do so. Right? If you have a Roth IRA, there is no requirement of distributions, and you don't have to pay taxes on it. So even if they had to take the money out, there are no taxes to be paid. So that solves a lot of problem. There's also a double taxation on traditional IRAs, because when the money comes out, not only you have to pay income taxes. Let's say if you're a beneficiary, it also goes into your estate, and you might have to pay estate taxes. That does not happen with the Roth IRA. You have that flexibility of being able to access your money at any time, which can make, for a lot more flexible financial planning when you're thinking about education funding or, different issues that you might have. So it's a very flexible option. Let's compare your options. So if you look at these are different types of IRA. So the first one is a traditional IRA where you can deduct the entire amount, right? Because you make less than a certain level. The second one is a non-deductible IRA. You can still make the contributions, but you were covered by employment plan and you make more than a certain amount, so you couldn't make the deductions, but you could still put the money in and get the tax deferral. The third one is the Roth. As you see, the traditional IRA would lend you, after 20 years, $2,000 contributions, assuming an 8% return. At the end, you would end up with $77,100 right? Because you would have to pay $21,000 in taxes. For the non-deductible IRA, you would have to pay less taxes because your contributions are not going to be taxed. So just the tax is only on the growth, right? So you ended up with $85,900. With the Roth, because you have to pay no taxes, you then ended up with $98,000. So it's quite a bit of a jump. There is a caveat here. So the $95,000 number considers a person who takes their deduction and then reinvests that deduction. But the truth is, how many of us actually, when you get a discount on something, has the discipline to take that money and reinvest in something else? Very few do, right? So if you do have the ability, you can almost come even, that discipline to do it, but most people don't. They don't, right? So that's the problem there. So if you try to find out which one is right for you,
I think that's the $1 million question.
Yeah. Well, here's some things to consider. First, are you going to reinvest those deductions? Are you going to be disciplined to reinvest those deductions? Is your tax retirement going to be a lot less than today? Because if it is, it can benefit you to have a traditional IRA. So let's say you make a lot of money when you are working, but you're moving to an area that doesn't expect you to have a lot of income. Your income is going to drop by considerably for one reason or another. You passed a lot of money, to your heirs in planning, etc. So that, in combination with you reinvesting your deductions, could really kind of benefit you if you have a traditional IRA. But if you don't think you're going to reinvest that money, you don't think your tax bracket is going to be that much lower in retirement, then you might be better off with a Roth. But that's a conversation for a more detailed conversation for each individual to have, right? So talking about conversions, there are a lot of people want to convert some of their traditional IRA money into Roth money. Just a couple of things to consider. One, you will have to pay taxes on the entire amount that you convert. And so just be prepared to have enough cash to be able to do that. And two, it's final. You used to be able to convert and then do a recharacterization, and now that's no longer allowed. So you just have to.
Is there a cap on the amount how much you can convert from the traditional to the Roth, or can you just?
It is not capped. So we call that a backdoor Roth. So a lot of wealthy individuals will do this. They'll invest into a traditional IRA and then immediately convert into a Roth. And so they bypass that prohibition of investing in a Roth when you make too much money. So there is no cap. You can do it as many times as you want for as much money as you want. It's a loophole. They know it.
That's a good one.
Yeah. So there's definitely an opportunity to do it. It's just, you just have to be mindful. If that year, for example, you're having a killer year, and then you make a conversion, your tax bill might be gigantic, right? So just make sure that it's not going to push you over to the next bracket and really ruin your tax plans, for example. So rollovers and transfers. Any qualified plans include 401ks, 403bs, 457, which are government plans, pension plans, profit sharing plans, can be rolled over into an IRA. And people should definitely consider this as an option when they leave their employment rather than putting into another employment plan. IRAs give you much larger options in varied options in terms of investments that you put in it. The IRA is just a shell. Whatever you put inside it is up to you, right? It can be real estate investments, it can be stocks, it can be bonds, it can be options. When you're in a 401k plan, you have the 20 funds that they give you, and that's it. And you don't really have control over, if they decide to change providers, fund providers. So you have a lot more limit. Your control over your assets are limited. The fees tend to be higher, and your investable options tend to be much simpler and less varied. So it's something. Of course, each individual situation is different, and we should discuss that individually. But it's something folks should consider for sure. Okay, so now let's talk about options for the self-employed and the business owner. So we have.
So this would be anyone who's self-employed, 1099, or any small business owner.
Correct. And even if you are employed, however, but you have self-employment income, you can have one of the. I would, in that case, would be a SEP, right? So a SEP is a traditional IRA that's meant for businesses, small businesses. Simple are like workplace retirement plans for businesses with less than 100 employees. So the SEP is a great vehicle. So the limits, the contribution limits on the SEP are much larger than traditional IRAs. It is either 25% of compensation or up to $58,000, whichever is lesser.
Right, so let me process this. So I'm self-employed. Let's say I'm a W-2 employee. I have a little sidekick as a freelancer. I get 1099, $10,000. So I can take 25% of those $10,000
and put
it into a SEP IRA.
Yeah. Well, let's say that you are, you're employed through a company, you make okay money, but then you start consulting, and your consulting business is doing a lot better, right? So you start making $200,000, right? So you can put, let's say you have $200,000 of consulting income, you can put up to $50,000 into a SAP, right? Not only.
And the SAP, that would act like the traditional IRA, correct?
Correct. You get a deduction for every dollar you put in.
Got it.
And the SAP is not.
So you pay the taxes. No, you don't pay the taxes.
You don't pay the taxes. You get a deduction.
Whenever you withdraw.
You would pay taxes on withdraw. But unlike the traditional IRA that has income limitations for you to be able to get a full deduction, the SEP does not have any income limitation in order for you to be able to get the full deduction. Whatever you put into the SEP, you're going to be getting a deduction.
And then you can just switch it from the SEP, and you can just convert it into a Roth.
Yeah, you could if you wanted to in the future. Yes. So the SEP, they're a little, the SEP is a little more complex when you talk about investment, the limit that you can invest if you're a self-employed person. If you're a business, though, if you at least have one employee, it's very simple: 25% of income or up to $58,000. There are, though, if you have employees, whatever contributions you make for yourself, you have to make to them, not in dollar amounts, but in percentage. So if you make a 10% contribution for yourself, you have to make a 10% contribution for them. But if their salary is 10 times lower than yours, their contribution will be much lower. You also will get a deduction for every contribution you make for your employees.
Got it. Well. So if the small business owner give himself the full 25%, has 2 employees, then he has to also contribute 25% of their salary, correct?
Yes, correct. So let's say the business owner, his salary is $200,000. He makes a 25% contribution, that's $50,000, but their employees are making $30,000, right? So there would be 25% of the $30,000 that he would have to make to each of his employees, and he would be able to get a deduction for that as well.
Got it. Perfect.
Yeah, there's no individual contributions to SAPs. It's only employers can make contributions to SAP. But often enough, you see this for solo practitioners, people who have 1 or 2 employees, but very often for very micro businesses, less than 10 people. Right. If you're going above 10 people, you usually use it's called a simple IRA. The simple IRA works pretty much the same way. It's very simple, like the SEP. There's no tax reporting to be done. Very simple to administer. The only catch here is that there is mandatory employer contributions. So the employer has to do either a flat 2% for everybody with a max contribution of $5,800 if he or she chooses that, or he can choose to match up to 3% of the employee if the employee contributes. So let's say you have 10 employees, one of them contributes 3%, you have to match 3%. 2 contribute 1%, you have to match 1%, and then the others don't. You don't have to do anything for the others. On the SAP, I don't think I mentioned this. You don't have to make any contributions. You can assess how your business is doing every year, and then you can decide, this year I'm making 25% contribution. Next year I decide that we didn't do it so well, and I'm going to make 0 contributions. As long as it's the same for everybody, you can do whatever you want, whatever is best for your business. On the simple, though, you always have to be making contributions. You have some flexibility, though, on the 3% match if that's what they choose. 2 of the 5 years, they can drop down to 2% or 1% up to their choice. So they have a little flexibility in terms of their contributions. So these plans allow you to put a lot more money for yourself, and if you choose to your employees, and get much larger tax deductions as well. There are other retirement plans out there that we can discuss in a different podcast or presentation. There are solo 401ks or 401ks, there are profit sharing plans, etc. But since we're talking about IRAs, I thought I should stick to IRAs. So that's about it. If you guys, there's a little visual comparison of both plans, how they work. And if you guys have any questions, I'll be happy to answer. Reach out to me, reach out to Raja, and he knows how to get in touch with me. And I'll be happy to answer any questions anybody has or will have, or All right.
Good stuff. It's obviously, it gets confusing, right? It's obviously a lot of information. So I do encourage anyone who's just curious about learning whether or not this would benefit them, and it will benefit families, right? Like I started the Roth IRA myself just last couple of years ago, and it's fun, right? Because you can invest in companies you like, you see it grow, right? So it's definitely worth it, especially the Roth IRA. Now, where people can reach you? Is there a preferred phone number or email address?
Let me go back to the first page, and they can see my contact information. I believe there's my contact information. If not, my phone number is 646-761-4372, and my email is maltoe@eaglestrategies.com. So M as in Mary, A as in Apple, L as in Lucy, T as in Thomas, O as in Oregon, E as in elephant @eaglestrategies.com.
Give me the number again. We're going to put it in the comments, all your information. Give me the number, 646.
Yeah, of course. 646-761-4372.
Perfect. Got it. So we'll put in the comments. Brother, appreciate you. Thank you so much. A lot of great stuff. We'll definitely have to revisit this, because I'm sure there's a lot of people inquiring about it, especially now, right? We've got, like you said, 2 months, 2 months away from really doing this, right? With the extension. Anything before we wrap up?
That's it. It was a pleasure being here. I hope we can do this again with this topic or another topic. And this is a pleasure. It was really a lot of fun.
Thank you, Marlon. Take care. Bye now.
All
right, everybody.